Hello everyone. Understanding Indian taxation is not easy. This becomes even more difficult if you are dealing with real estate transactions in India. I've seen countless NRI clients shocked when they discover that they need to shell out 12 to 30% TDS upfront on their property sales while their resident Indian friend pays just 1%. Navigating the complexities of property transactions in India as non-resident is always a daunting task. Budget after budget, taxation laws in India keeps changing. With significantly higher TDS rate, intricate surcharge structures, and specific compliance requirements, NRI property sellers face unique challenges that requires a careful planning and understanding. Today in this video, we are going to discuss all of that. If you have a property in India, this is a must-watch video for you. So stay tuned till the end. If you are new to this channel, I am CS Keerthina. I run the consultancy, a firm which is specialized in NRI services. Based in Dubai, we offer NRI investing, finance, tax and FEMA services. If you are interested to avail any of our services, please feel free to book an appointment by visiting www.keerthisfinfo.com or contact this number through WhatsApp. I have completed my CS from India and CMA strategic level from UK. I am also SEBI registered overseas MFT. Every week, I bring you and explain a video on NRI related issues. If you are looking for finance, investment and FEMA related topics, please consider subscribing this channel. It means a lot for all the efforts that we are putting. In today's video, I want to explore answers to 10 frequently asked questions that my clients ask me with regard to the property and its taxation in India. So, without delay, let's start with the first question. First, what are the difference in TDS between NRI and resident Indian? Many NRI still don't know. The taxation landscape for NRI differs significantly from resident Indians when it comes to property sales also. While resident Indians are subject to modest 1% TDS on property sale above 50 lakhs, that too, NRIs, they face substantially higher tax structure. And in case if you're thinking what is TDS, it is a tax amount which is withheld by the government during the sale. As an NRI seller, you were required to pay 30% TDS on the properties for short-term gain and 12.5% for long-term CG. This is a change after 2024 Finance Act because the long-term capital gain had been reduced to 12.5%. According to that, even our TDS rate is also changed. So now it is 12.5% plus cess plus surcharge. And the responsibility is always lying with the buyer to deduct TDS. Do you think complexity ends here? No. The tax structure includes additional surcharges based on the sale value. No surcharge up to 50 lakhs rupees. So effective TDS inclusive of cess is 13%. And the surcharge of 10% between 50 lakhs to 1 crore. This is applicable. So it is giving us a total tax rate of 14.3%. Next category, surcharge is higher at 15%, that is above 1 crore. That means total effective TDS here is 14.95%. You have to understand one more point here. TDS is on the total sale consideration. Now imagine how much as an NRI we are taking the burden. So the significant upfront TDS payment means you have less immediate capital available for whatever reinvestment or other financial commitment that you would be having. While this excess TDS definitely can be claimed as a refund later, there is a temporary blockage of funds. This can affect your overall investment strategy. While selling the property, these are the points NRI should keep in mind. So now let's take up the taxation part. Second, how does the classification between short-term and the long-term capital gain impact NRI property sales? See, when you are calculating tax, the holding period, it matters a lot. It plays a crucial role. If you're selling a property in India within 2 years of acquisition, then it is under short-term capital gain. So this is subjecting you to the higher tax rates and fewer benefits. If the property held is more than 2 years, then this is qualifying for long-term capital gain treatment. So this LTCG generally enjoy the benefit of indexation, but this 2024 year's budget, they have removed that also for NRIs. I am going to explain everything about this in detail in the later part. So now what you have to know is the long-term capital gain is taxed at flat 12.5%. So when your short-term gains are taxed at your income tax slab rate, which could be as high as 20 or 30% plus applicable surcharges, think of LTCG also. So many figures I'm quoting may be new for you because the budget 2024 has really impacted a lot when it comes to property tax, that too in NRI context. So this takes us to the third question. How has budget 2024 changed the tax landscape for NRI property sellers? See, the 2024 Finance Act, it had introduced significant shift in LTCG or long-term capital gain calculation. So while LTCG tax rate has been reduced from 20 to 12.5%, don't smile, this comes with a critical caveat for NRIs. Unlike resident Indians who still enjoy flexibility to choose between old regime, that is 20% with indexation, and the new regime, that is 12.5% without indexation, NRIs, they are automatically placed under new regime. So you don't have any option to claim indexation benefit. It is flat 12.5%. This change particularly impacts NRI selling properties acquired before July 23rd, 2024. For instance, if as an NRI you have bought a property in 2010 for 50 lakhs and I was selling it 2025 for 2 crores. So they must calculate the gain including the inflation. Now this is removed. So without taking the inflation into account, the capital gain is going to be taxed for NRIs. So this takes us to the fourth question. What impact does the removal of indexation have on NRI property sales? Is it bad or is it good? See, the removal of indexation benefits creates a substantial financial burden for NRI property sellers, especially those who are holding long-term or inherited properties. Under the old system, indexation helped to reduce the taxable capital gain by adjusting the purchase price with inflation. So now there is a flat rate of 12.5% and you can't adjust for inflation. That means you as an NRI is going to pay more tax on the properties held for extended periods. Remember, the removal of indexation and the introduction of 12.5% may be good in some contexts for NRIs. So depending on the holding period, rate of return and many other circumstances. So there is no general answer. But usually this is what we have observed. It's not good for NRIs. You need to understand the capital gain tax structure also for NRIs. So this is bringing me to the fifth question. What is the methodology used for calculating CG or capital gain on NRI property sales in India? See, the calculation for capital gain follows different methodologies based on the holding period. For short-term gains, calculation is relatively straightforward. Take your sales price, subtract all the purchase cost, which includes the acquisition price, registration cost, documented home improvement, everything. And the long-term gain calculations incorporate powerful tool of indexation. Talking about earlier, before Finance Act 2024. So in this process, you could have adjusted the purchase cost using something called CII or Cost Inflation Index. So this is a figure which is published by the government which acknowledges time value of money. So there's a formula which generally involves multiplying your original purchase cost by the ratio of CII for the sale year to the CII of the purchase year. But remember, like I said earlier, now there is no need of analysis because this is completely taken out for NRIs. See, if you are an NRI, you don't have any choice of choosing indexation benefit. So if you are selling the property, you end up paying higher TDS. Now, this brings us to the next question. Sixth question. What is the rationale behind higher TDS rate for NRIs? I have to answer this bit academically. See, the government approach to NRI property taxation is basically rooted in practical consideration of tax compliance. Higher TDS rates serve as an effective protective mechanism for them to ensure tax is collected before sales proceeds are taken out of Indian jurisdiction. So this acknowledges the challenge also in international tax recovery. Once funds move out abroad, then the Indian tax authorities face significant hurdles in recovering any kind of unpaid taxes. This might involve complex international banking or legal rules, frameworks. So the higher TDS rate essentially is acting as their security deposit for the government. Actually, this is a tax compliance upfront. The system also reflects government's balanced approach to encourage NRI investment while maintaining the tax compliance. When the initial TDS might seem very high, but there is also provision of obtaining LDC or lower TDS deduction certificate, where the actual tax liability might be lower. So now let's see. That's the seventh question. What are the methods available for NRIs to reduce the TDS burden? The most effective tool available, as I told earlier, is LDC or Lower Tax Deduction Certificate. So this certificate issued by Income Tax Department allows for a reduced TDS rate based on your actual expected capital gain rather than standard high rate of 12.5% in case of LTCG. The minimum TDS rate achievable through this route, LTC, is 3%, which applies in cases where you might be incurring loss on the sale. So the process of obtaining LDC requires meticulous documentation and advanced planning. See, there are a lot of essential documents required: complete purchase records, payment proofs and improvement cost bills, agreement to sell, KYC documents of the both parties, and so. So additionally, your PAN card also should be operative. The buyer need to obtain TAN or tax deduction account number. Working with a qualified chartered accountant is really critical here, as they can accurately calculate, making some cost benefit analysis, what is your expected gain, and prepare a comprehensive application. So this takes us to the next question. Eighth, what is the optimal timeline for planning, if at all an NRI is thinking of property sales? The ideal timeline for NRI property sale begins at least 2 to 3 months before the intended sales date. This buffer period is critical for several reasons. See, obtaining LDC, lower TDS deduction certificate, it takes around 30 to 45 days. Ensuring that your PAN is operative, then it can take up another 15 days. Buyer stand registration, another 15-20 days. So planning this timeline effectively, they can prevent last minute rushes and potentially any kind of financial strain. So that's why I'm telling 2 to 3 months. A strategic approach to the timing becomes really critical here while considering the financial year implication. If you're planning the sale near the end of the financial year, that is March, then you need to factor in that for new LDC application, because it's necessary if the sale extends to the next financial year, because the validity of LDC is only 1 year. So timing of your sale can affect your ability to reinvest in tax saving instrument or new properties within the specified time frame also. So this timeline should also account for the market conditions and personal tax planning. Consider all these factors along with property market cycle in your area, the timing of tax filing season in both in your country of residence as well as in India. In general terms, liquidating real estate needs longer time. So please be prepared for it mentally. Let's assume you have sold the property. This takes us to the next question. That's ninth question. What are the essential next steps for NRI property sellers? The first critical step is to assemble all your documentation toolkit. This includes gathering all property related documents such as original purchase deed, previous sale deed if any, tax receipts, improvement cost bills, and ensuring, of course, PAN should be active. And additionally, you have to also start maintaining the record of communication with potential buyers, property valuations to support your sales price justification. Engaging with professional tax experts is also equally important. A qualified CA can, of course, help you to navigate this complex compliance tax implications, while a legal expert also can ensure proper documentation with the latest regulations. So for NRIs, it is particularly important to have reliable representatives in India who can handle various aspects of this transaction. In case if you don't have that extended period of stay in India, including documentation, banking, and communicating with the tax authorities, you can think of executing a GPO for that. One often underlooked aspect is documentation requirements specific to inherited property. This brings me to the 10th and the last question of today. What are the considerations for NRIs selling inherited property? When you're selling inherited properties beyond the standard property papers, you will need the previous owner's death certificate or a legal heir certificate or a will, succession certificate, all depending upon the circumstance. These documents are crucial not only for the tax purpose but also for obtaining your LTC or lower tax deduction certificate. Additionally, if you have multiple successors involved in this case, then you will need a clear documentation showing the division of property, NOC from others. So as this can affect both the cost basis calculation as well as the tax liability distribution. The most significant advantage here is the cost of acquisition for inherited property is taken as a cost to the previous owner or your parents. The holding period is calculated from when the previous owner had acquired that property, not when it has come to you. So this means if your parent had purchased the property in 2000, you are inheriting it 2020, your holding period is calculated from 2000, not from 2020. So this potentially qualifies you for long-term capital gain treatment. The cost basis calculation for inherited property follows special rules. So what is that? You have an option to use either actual cost paid by the previous owner or FMV, fair market value of the property, as on April 2001, whichever is higher in case of old properties. I mean the property which was acquired before this date. This can significantly reduce your tax liability as it effectively allows you to step up the cost basis to a more recent value. For example, if your parent had bought a property in 1990 for 10 lakhs rupees and its fair market value as on April 1, 2001 was 50 lakh. So you can use 50 lakhs as your cost basis because it's reducing your capital gain. If you as an NRI sell an inherited property after parent's death, then you will need to show succession certificates, mutation certificate, title deeds, and all the list of the documents are quite lengthy. So again, as I said earlier, involving a CA in this context will definitely be worth the money. It's not easy to interpret, navigate the tax complexities in India otherwise. That's it for today. Keep an eye on Union Budget on February 1st, 2025. Things may change again. In these issues which I have discussed in the video, if you need any professional consultation, then please feel free to write to info@keerthisfinfo.com or visit www.keerthisfinfo.com and book a meeting. And don't forget to share the video with your NRI friends, and of course, go and like the button because it's free. See you with another video. Till then, bye bye.